So interest rates have risen once more here in the UK. For the third successive time, we've seen a jump up. So we're now at 0.75%. This was an increase from 0.5%, which went up in February, and that was an increase in itself from 0.1%, which was the rate in December. In fact, that rate stood like that until 2 years ago. In fact, we're now back at that level we saw pre-pandemic in March 2020, 0.75%, and we're there again. So 3 successive increases. That's kind of the first time this has happened in, well, if ever, for a long time. Really rare for that to be happening. And we are now at a place where, if you're a borrower or a saver, this rate is going to have some kind of effect on you. And I'll go into that in a minute and sort of tell you what maybe the top things you should be doing. Before that, though, just some things from the meeting, the Bank of England meeting that took place today, that are also of interest here. So previously, they'd said that a prediction for inflation in the second quarter of this year, so springtime, April, May, something like that, would be that inflation, which is the measure, the official measure of how much prices are increasing, would peak at around 7.25%, which is massive. You know, their target is 2%, so 7.25% is massive. And then it would start going down. So we would kind of getting back there. Things wouldn't be so crazy after that. Well, they're now saying that would be actually likely to be around 8%, so maybe even a little bit more of that, in the next few months, next month, maybe the month after. We'll know next week exactly what the most recent figure is. That will happen next Wednesday. But at the moment, we're not quite sure where we are. Currently 5.4%. Imagine it would go up a little bit before that if it's going to get to 8% in the months after. But that won't be the peak necessarily because, and again, we know everything that's going on with energy prices, just due to the broader things, but also what's going on in Ukraine has really kind of pushed that up. If we see another massive increase, and it's likely to be a larger increase than we anticipated in October, when the price cap increases again, then it could see an even larger peak on inflation. So it's going to be a while before it starts dripping back down. So that's important to know. Now, I know, when you look at the comments, when I've done these updates on previous inflation announcements and Bank of England interest rate announcements, a lot of your comments were around, but that's not even real. Inflation really is actually higher. And then on the things that we see day to day, most of the stuff we're actually spending money on, then absolutely, inflation does already feel higher than the current 5%, higher than possibly this 8% we might get next month. And who knows how high it can be. I've seen speculation that it could get as high as 10%. But again, that's the official figure. So we will see it, and we do see it at the petrol pumps, in the supermarket, on our energy bills. Some of those things, those real kind of essentials, potentially costing even more. So just bear that in mind, okay? Things are going to continue to get more expensive compared to how they cost a year ago, and that will continue as the year goes on. So it's about finding wherever you can those places to really kind of like streamline your expenses, make some savings, potentially make some sacrifices if you have to, or maybe just getting that best deal. That is going to carry on for a while yet. The other thing sort of to mention here, just very briefly, you might remember last time I mentioned the 9 people from the Bank of England who vote on this base rate. Back in February, the vote was split 5-4. 5 in favour of an increase from 0.25% to 0.5%, which is actually what happened because that was the majority. But the other 4 were keen, they were quite hawkish is the phrase, they were kind of keen to go even further, go then from 0.25% up to 0.5%, which would have been, up to 0.75%, which would have been a really massive jump in one go. Obviously, it didn't happen, 5-4 in favour of that one we saw. This time, the majority was 8-1 of that 0.25%, 2.25 percentage point increase to 0.75%. 8 of them wanted that, and the other person didn't want higher. They wanted to keep it as it was. So we weren't ever in danger here of the rates really going much beyond where they are. But we could see this, and we probably expect to see further increases. This is probably not going to be the end of it, particularly if, as you said, they expect inflation to carry on getting higher and peaking again in the autumn. There is one line in the minutes from this meeting that kind of says that the markets are pricing in a potential 2% interest rate, Bank of England interest rate by the end of the year. So that would be a massive increase. We consider at the start of December of 2021, we were on 0.1%, potentially to be around 2% 12 months later. Really quite significant. But we don't know. The whole world is changing so fast all the time that it could be higher than that, could be lower than that. Something else could happen massively and things disappear. You never know. But that's kind of where the economists and the analysts are kind of seeing it potentially could be going. But absolutely, I wouldn't expect this increase today to be the last one over the coming months. So what does that mean? What's that actually mean for you and your kind of pounds in your pocket? Let's talk about borrowers first of all, because this is one of the things where you can potentially take action, and you should take action if you haven't already. Hopefully, when I was talking about this back in November, you were already kind of right. Let's get on the cheapest fix that we possibly can. Let's take advantage of those really low deals that were available right then. If you missed out then, hopefully you did that in the previous months. But the more these rates increase, the more those cheapest fixed deals for your mortgage are going to disappear. They already have gone. The best ones, the next best ones have gone. The next best ones have gone. And if the journey that is expected on that base rate is to continue getting higher, then that will carry on. So if you are on a fix that's due to finish soon, you can get a new fix sorted possibly 6 months before you need it. So if at any point now between the autumn, you can lock in a price now. Don't have to take it on until later on. Or if you're applying for a mortgage for the first time, often they will last for about 6 months. If you are on a variable rate tariff right now, this is one of the most expensive ones. And appreciate there are a number of people who are called mortgage prisoners, right? So they can't, if they would love to get off this variable rate one, but they can't get on a fix. But if you are able to, you've dropped the ball slightly, other things have got in the way of your life, or you weren't even across it, have a look now. Get off those variable rate ones because they are going to be the most expensive ones. Although they might not have increased today or tomorrow, they're likely to follow this increase in the coming weeks and get more expensive again and continue that way as if we get more increases. So try and get a fix if you can. If you are on a tracker rate, then you will see almost straight away today your mortgage will go up and be more expensive. And in fact, between people on variable rates and tracker rates, the average, I've looked at a few different sources, between sort of £16 and £32 a month is kind of the average increase depending on the different sources and your type of mortgage, the length of mortgage, but that kind of thing. Obviously, if you have a bigger mortgage with a higher rate, could be even more expensive. A smaller one might be a bit less, but that is per month, and that's on top of the increases we've already seen the last few times. So again, it can be getting quite a lot, significantly more expensive year on year. If you're on that tracker rate, it will happen almost straight away. Again, you might want to see if there is the potential for you to fix and move off that tracker rate. Depends if there is a term for that. Watch out for any kind of exit penalties on any kind of mortgage, actually, that might kind of closing it down early could cost you a lot more than you'll make by switching it. Or conversely, that exit penalty might not be huge and it might be worth paying that if you want to lock in and get some kind of surety on a rate right now in case they do keep going up. Now, how long you might want to fix for, that really does vary about how you feel comfortable with, because you can get a 2-year fix, 5-year fix, 10-year fix. Now, you might think that things are going to get better, in which case you only want to do a 2-year fix because things will come back down. Maybe. We just don't know. 5 years gives you that a little bit more. 10 years, you might go, yeah, absolutely, I want to lock in 10 years. No, that's what I'm paying for the next 10 years. I can afford it. That's great. Run the risk there that obviously the prices could significantly fall and you're in a mortgage it's hard to get out of. You might also want to consider overpaying your mortgage if you are on any things, whether it's a fix that's coming to an end or whatever. But at this rate you've got now, which is maybe a bit lower, overpaying, getting it down as much as you can while it is that little bit cheaper. Now let's move on to other forms of borrowing now. Not going to see massive changes for you if you've already got a loan or a credit card. Generally, they're going to say, well, a loan's going to be fixed anyway for the duration of a loan. A credit card, they might increase the rates, but as I always say here when I talk about credit cards, please try to pay off the full balance every single month so you don't get charged interest at all. That's the ideal world. If you are getting charged interest on your credit card debts, and that maybe will increase, potentially either your existing cards or new cards, try to look at a 0% card to bring it down to 0 so you can really tackle it as much as you can. 0% balance transfer, 0% money transfer for maybe some other debts. But broadly, nothing's going to change for you there in those other forms of borrowing right now. Maybe new borrowing will get more expensive. That's probably likely if you need to get a new loan out in the coming months. That'll be more than it would have been, last month, 2 months ago, last year. Lastly, let's talk about savings here. And this is where maybe you're thinking, that's a silver lining. Rates pushing up means I'm going to get more on my money stored in that savings account. Well, let's to really what difference is 0.25 extra on the base rate is going to mean for your savings is look what happened a month ago, 6 weeks ago, when it increased by that amount. And yes, we've seen the best easy access accounts and the best 1-year fixes and other fixes increase for the top ones, but not necessarily by that amount. So let's say, I can't tell you off the top of my head, I think it was around 0.7, 0.75% for the best easy access account 6 weeks ago. 0.25 was added on to that. So you'd expect maybe we're getting up to close to 1% on those, a larger sort of group of accounts. And although there is one account that's gone up to 1%, and we'll come back to that in a second, most of the best of the other easy accesses is actually around 0.82%, I think, right now. Flexing around a little bit. So it's increased, but not by that full 0.25%. And in fact, The vast majority of savings accounts have stayed at this as they are. They're still really rubbish. They're paying 0.01%, 0.2%, whatever it might be. They haven't passed on that full amount. Another good example here is Marcus, which has been a good account for a long time, one of the best buys. That was at 0.6, is now at 0.7%. So it's increased, but not by that full 0.25, which means if the same thing is to happen now, well, we're still not going to see a huge, an extra 0.25% on the current rates on the whole. I wouldn't expect. Maybe one or two places will do that. One or two places will start push us, nudge us closer to 1% on easy access. Maybe we'll see some regular savers, which always used to be really kind of nicely paying before. Maybe we'll start seeing them nudging. The best ones right now, 2.5%. Maybe we'll get closer to 3%. You never know. But I think it's going to be a few individual banks which are doing this, and they're doing it more as a marketing ploy. So the 1% account I mentioned before, I've got a whole video you can check out if you want to from Virgin Money. 1% on the first 25k you have stayed in that account. That is the best rate right now, significantly so. That might have people catching up with it. They might decide to increase the rate themselves. We'll have to see what happens. My top tip here with savings, as ever, is if you're sitting in an account which is earning absolutely nothing at all, get it in one of the best paying ones right now. If you're in one which isn't too far off, then just do some basic maths and just work out how much difference you're going to make by moving it. Because if you've got a low amount of money and you're currently getting 0.7%, to move it to one that's getting 0.9% or 1%, it will make a difference, but maybe not much difference. Maybe you want to wait and see what else happens longer term. But that might sound, so there will be some movement in some cases, which is good news, but it's still, remember they've talked about inflation before. If inflation is really going to rocket up, if we're looking at more than 8% in the next couple of months, maybe even getting to 10% by the later this year, that's still a massive difference. So it's not really a win for savers. It's better than nothing, and it's important we have easy access savings at the best rate you can, but you're still going to be losing out longer term. And obviously it's very complicated right now to decide what you do with your excess cash with such sort of fluctuations in the investing market. But you can obviously look at putting more into your pension, more into overpaying your mortgage if you're not sure what to do there, or perhaps it's a mix of them all. So some in easy access, the best rate you can, some overpaying your mortgage, some extra into your pension, and some into stocks and shares, ISA. And hopefully longer term, you're going to get a closer return to whatever inflation might be than just having it sitting in whatever basic savings account you've got. My name is Andy Webb. Thank you so much for watching. Check out these videos for more. Let me know what your feeling is on the latest interest rate below.